Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar took a breather this week after a massive sell-off earlier in the week. The DXY bottomed out at 103, the low it hit before Trump's election victory. However, by the end of the week, it had rallied back to 104. The accumulated oversold condition gives room for a bounce, but there's also a chance that the situation could quickly develop into a new dollar momentum. Over the past 3 years, the dollar index has reversed to the upside on drawdowns near the 200-week moving average. It is now above 102.2. The dollar reversed to the upside twice, in similar conditions in 2023, and briefly dipped lower in 2024. Interestingly, the changing fundamental backdrop has been working against the dollar all along. Slowing job growth and cooling inflation worked against the dollar as the date for a rate cut approached. However, this did not prevent the dollar, which had become overbought in previous weeks, from rising. The pressure on the U.S. indices has intensified. The acceleration is explained by the change of the market regime to bearish. Last week, the S&P 500 and Nasdaq 100 closed below their 200-day moving averages. The key U.S. indices have not traded consistently below this curve since early 2023, and a dip below it in early 2022 signaled the start of a broad correction. Now, the trillion-dollar question is, when will the bottom be? It is commonly said how important it is to be bold when everyone is afraid. The sentiment index is in the extreme fear zone, and earlier in the week it was down to 14. These were the lowest levels since May 2022. But a word of caution to early buyers. In the previous market cycle, the S&P 500 did not bottom until October, 5 months later. Another measure of fear, the VIX indicator, remains above 20, indicating heightened investor nervousness. Daily timeframes show oversold conditions, with the RSI index last hitting this level in early 2020. However, similar conditions occurred nearly 20 times in 2018, signaling extreme oversold levels. Back then, the market experienced a brief bounce rather than a full reversal. The technical picture makes us cautious about short positions, suggesting a high chance of a bounce or a reversal. However, signals from Trump or Powell-level politicians are needed to ensure a reversal. The gold price has returned to renewed historical highs, which are now above $3,000 per troy ounce. On the tech analysis side, we see a typical resumption of growth after a corrective pullback. As we repeatedly noted earlier, the potential target of this growth impulse looks like the area of 3,190. A more distant growth target looks like the area of $3,400. Not typical in this case is the fact that the increase in the price of gold occurred sometimes simultaneously with a strengthening of the dollar, and sometimes together with the fall in the stock markets. The only reliable correlation we see with gold is sentiment on global monetary policy. Economic weakness and slowing global inflation are fueling the rise in the price of gold. The crypto market declined during the week to a total capitalization of $2.5 trillion. This is one-third lower than the peaks in December last year. However, towards the end of the week, we could see attempts to stabilize the market, with a rebound of $2.67 trillion. Despite the growth attempts, only if the market breaks above its 200-day moving average will we be able to take it as a signal of a return to growth. For now, the market dynamics resemble no more than just a bumpy downtrend. The story is similar in Bitcoin, where the bears are regaining control of the market on bounces to the 83,500 area. A 200-day moving average is near this level. Ethereum is in a steep decline, having pulled back below $1,900. At its low point, it was below $1,750. It hasn't been this cheap since October 2023, losing over half of its price since its peak in mid-December. The new week will be packed with economic data and decisions from key central banks. On Monday, U.S. retail sales for February are expected to show a rebound after a disappointing January. Early on Wednesday, the Bank of Japan's key interest rate will be in focus. The consensus forecast is for it to remain at 0.5%. However, be prepared for unexpected decisions and sharp comments that could affect the yen. The focus will shift to the U.S. at the end of Wednesday. The Fed is not expected to make any policy changes, but the investment world will be watching closely to see when the next easing will take place. On Thursday morning, the Swiss central bank will release its quarterly interest rate decision. On average, analysts are predicting a 25-point cut to 0.25%, which would be a 3-year low. On Thursday afternoon, the Bank of England will release its interest rate decision. Following February's cut, it is expected to be unchanged this time. However, Friday's batch of weak macroeconomic data could strengthen the position of the doves on the committee. Stay tuned to Pro News Weekly for more updates on global markets. like, share, and subscribe.